Hi guys, I'm Phil Town from Rule 1 Investing, and today we're going to talk about a very controversial topic in value investing circles. Is China currently a golden opportunity, or is it just one giant value trap? It's no secret that over the past few years, China's economy has really struggled, and that's crushed the share prices of a lot of their biggest companies. But here's the interesting part, you guys. These are still some of the largest, strongest businesses in the world. We're talking Alibaba, Tencent, Baidu, JD, the list goes on. So what's the deal here? Is this the value investing deal of the century hiding in plain sight, or is it all one big value trap? Now, a lot of you guys know I like to look at the 13F filings of some of the world's greatest investors, right? Just don't like you looking at mine. But besides that, I like looking at theirs, and we're talking about Warren Buffett, Li Lu, Mohnish Pabrai, Guy Spear, and so on, other great investors. And it's like these amazing investors would just call me up every 90 days and tell me what they've been buying and selling, which is amazing. So over the last few years, I've seen a lot of great investors buying into these big name Chinese companies, all buying into big names like Alibaba, Tencent, Pinduoduo, JD, and Baidu. And it's for a good reason, right? They're buying because these stocks got really cheap. And then many of these same investors sold out. So what's going on in China? Now, this is where we need a little more context, because in this case, it actually turned out to be a cascade of factors that caused a kind of perfect storm of share price collapses that both took in great investors and then took them out again. The first factor that happened was COVID. In early 2020, China started enforcing extremely strict lockdowns, and those continued for a really long time. That hammered their economy and left people cautious even after the restrictions got lifted. Chinese consumers just didn't rush back into the spending. They instead tightened their belts. And when people are holding back on spending, companies like Alibaba and JD don't see the sales growth they need. Alibaba's stock price peaked at $304 in 2020 and then tanked. And that's when some great value investors jumped in. The next wave of the cascade was the real estate crisis. You've probably heard of China's 3 red line policy. In mid-2020, the government stepped in to stop property developers from taking on too much debt. Now, property makes up a massive part of the Chinese economy, and when developers suddenly couldn't borrow freely anymore, a lot of them started failing. House prices began to fall, and that hit the wealth of the average Chinese family really hard. And when people feel poorer, they stop spending, which is bad news for the companies we talked about right across the board. Now, some of the best investors in the world believe that these developments were events that had an end point. That's the key thing. They had an ending point. They would get corrected. And certainly, these things did not mean a long-term change in the 2-decade Chinese economic growth story. But then, the third thing happened. President Xi went after some of the country's biggest internet companies, issuing fines, introducing heavy new regulations, putting a lot of pressure on them, while purging his government of leaders who had believed in the entrepreneurial foundation of the new Chinese economy. Meanwhile, leaders at Alibaba, Tencent, and others suddenly found themselves under intense scrutiny, if not house arrest. Xi sounded a lot more totalitarian than the previous 2 decades of Chinese leadership, and that scared investors both inside and outside China. And that was the event that had so much uncertainty to it about the future that it triggered the exit for some of those same great investors. This re-emphasis on communism was a major change in the China story that might not have a happy ending for enterprise investing. So what about now? These stocks look super cheap. Are they a value investor's dream? Are they a massive value trap? Well, you can probably see where I'm going on this one. First things first, one of the core rules of value investing is to only invest in businesses you truly understand. Now, what that means is that you are highly confident that you know these businesses will be bigger and more successful 10 years down the road. And for most Western investors, Chinese companies operate in such a completely different environment, different culture, different government, different accounting standards, and you can't confidently say you understand who even actually owns the business. Here's a clue. It isn't the US shareholders that think they do. How this business works is a mystery sometimes, how the environment affects it, much less whether it'll even be functioning as an independent business in 10 years in a communist country. If that's all the case, then maybe this doesn't belong in your portfolio, sports fans. Second, the relationship between China and the West, especially in the US, has gotten more tense in recent years. Tariffs, sanctions, restrictions on technology export, These all have a direct impact on Chinese businesses. Even if the company itself is strong, these geopolitical headwinds and layers of risk can be outside of your control as an investor. Charlie Munger said his Alibaba investment was a mistake. Manesh Prabrai realized that regulatory environment had radically changed, so he exited. I saw the major change in the China story that made the future uncertain, and I got out and took the loss. Now, this was a harsh reminder that the first rule is don't lose money. Before I invest, I have to seriously consider how I could lose money on this investment and then avoid doing those things. It's a pretty simple idea, right? That, in fact, is the main consideration before investing. How can this thing go off the rails? Now, if I'd asked that as seriously as I should have, looking for real problems that could occur, the answer might have been right in front of my face, and it might have been pretty easy. This is a communist country that doesn't play by the same rules as the West when it comes to business. I could lose if they changed the rules. Why didn't I see that? I just relied on the previous 20 years of communist interaction with their entrepreneurial enterprises, and I was wrong. So the question I should have asked is this: can I really be confident that I won't lose money in China? With a mix of regulatory risk, political risk, cultural differences, that answer should have been no. I cannot be confident enough that it isn't a gamble, and that means it isn't a Rule 1 investment. Now that's the harsh reality of Rule 1, looking for how to avoid losing money. And if you guys would like to learn more about these classic Buffett-style philosophies on investing and how to actually implement the Rule 1 strategy from start to finish, I would love to invite you to our next 3-day Rule 1 investing workshop. You're going to learn that investing isn't about how smart you are. It's about how disciplined and patient you can be and how well you can follow the rules. We teach entirely online and go through the full 4-pillared investing approach that we have taught to over 25,000 people around the world. And we're not like those workshops where they just upsell you and never teach you anything. We just teach, no selling, zero. The stats don't lie. Our participants love this workshop with net promoter scores that beat even the likes of Harvard and Yale. And you get the benefit of investing lessons learned the hard way, like this one, from people who do it every day with millions of dollars. So if you'd like to get serious and really take charge of your financial future, please come and join us. The details for that can be found in the description pinned comment below, and also by scanning the QR code on the screen. And that said, you guys, thanks for watching. Now go play.